To understand how one man orchestrated a $65 billion deception, we have to look at the world he operated in. Bernie Madoff was a pillar of the Wall Street establishment, commanding absolute trust in an environment built on skepticism. Madoff was an early adopter of electronic trading. By 2008, his firm had become the sixth-largest market maker for S&P 500 stocks, and he had risen through the ranks to serve as the chairman of the Nasdaq. This chart shows the massive scale of his advisory firm by 2008. The central bubble represents the staggering $65 billion he claimed in client accounts, a figure that dwarfed the assets of his most successful competitors. Behind this massive public footprint, Madoff ran a secondary, secretive investment fund. It operated as a black box, available only to an elite circle of clients who had no ability to verify how their money was actually being managed. Despite that $65 billion valuation, investigators found the firm wasn't making trades. All that wealth was a fabrication. This raises the central question: how did a scheme this rudimentary survive for decades in plain sight? The actual mechanics of the operation were simple. When investors handed over their money, those funds never entered the market. Instead, Madoff deposited every dollar into a single bank account. Inside the firm, employees manufactured performance reports to create a paper trail. They used historical market data to fabricate backdated trades, making it appear as though the firm was successfully timing real market conditions. This graph displays the mathematical impossibility of those reports. While the volatile background line shows the chaotic reality of the stock market, the smooth upward line in front shows what Madoff reported: a consistent 10 to 12% annual return, even when markets crashed. To keep that smooth line growing, the system required a constant inflow of new money. When an existing client wanted to withdraw their earnings, Madoff simply paid them using the deposits provided by the newest investors. Behind the complex financial terminology and the pristine Wall Street reputation, this operation functioned as a classic Ponzi scheme, propped up by fraudulent internal accounting. Madoff employed an unusual marketing strategy. He refused to pitch his fund. Instead, he relied on word-of-mouth referrals, turning investment into a private club and manufacturing a sense of exclusivity. He targeted tight-knit, wealthy social circles and prominent charitable foundations. As more respected individuals joined, a network effect took hold. Access to the fund became a coveted status symbol. This strategy drew massive investments from family offices and charities. Entire organizations handed over tens of millions of dollars. The foundation associated with Nobel laureate Elie Wiesel alone lost $15.2 million when the structure collapsed. Investors fell into the psychological trap of social proof. When they saw their wealthy peers and prestigious organizations entrusting their fortunes to Madoff, they assumed the necessary due diligence had already occurred. Exclusivity acted as a cognitive blindfold. The illusion of safety was so complete that some of the world's most sophisticated investors handed over their fortunes without asking basic questions about how the returns were generated. Not everyone was blinded by the prestige. In 1999, financial analyst Harry Markopolos looked closely at the numbers. Within minutes, he realized the math was impossible. Markopolos zeroed in on a discrepancy in the options market. The actual volume of trading in those markets was too small to support the massive returns Madoff was reporting. The trades couldn't have existed because the market itself wasn't big enough to hold them. Over the next decade, Markopolos sent repeated, detailed warnings to the Securities and Exchange Commission, explicitly outlining the fraud. Despite the mathematical proof, these warnings resulted in no meaningful intervention or audits. The massive scale of the fund created an armor of legitimacy that overpowered fact. Regulators couldn't accept that a $65 billion empire, run by a former Nasdaq chairman, was built on false information. The illusion didn't end because of a government investigation. It was shattered by the 2008 global financial crisis. As global markets collapsed, widespread panic set in. Fearful investors all rushed to pull their money out of the market at the same time, triggering a wave of withdrawal requests that Madoff's firm could not meet. This chart shows the fatal collision. $7 billion in requested withdrawals dwarfed the $234 million remaining in the master account. The liquidity structure collapsed. The financial crash halted new deposits. Madoff couldn't cover the shortfall, and the fraud was finally exposed. A Ponzi scheme can survive skepticism, but it cannot survive a lack of liquidity. The moment it runs out of cash, it fails. With the bank account empty, the unraveling took only days. Madoff confessed to his sons that his entire investment business was a lie, and they contacted the authorities. The legal consequences were swift. He pleaded guilty to 11 federal charges and received a sentence of 150 years in federal prison. The human impact was devastating. $18 billion in actual cash vanished. Thousands of people saw their life savings erased, family legacies were destroyed, and charities were forced to close forever. Madoff spent the rest of his life incarcerated. He died in a federal medical facility at the age of 82 while still serving his sentence. The Madoff scandal serves as a warning. In the financial world, prestige and exclusivity can be used as a shield for deception. When measuring risk, social proof must never be a substitute for hard data.